Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining me is Gary Schlossberg, global strategist at Wells Fargo, to discuss if the business cycle is dead or not. Gary, it's great to meet with you. Welcome to Trade Talks.
Thanks. Good to be here.
And Gary, it seems like the economy and markets have lost its ebb and flow, and it's these moves to one extreme side or the other. Would you say that the business cycle is dead here?
Certainly doesn't indicate it, given the volatility we've seen of late. A lot of uncertainty about just how potent fiscal policy would be. The Federal Reserve still maintaining a fairly dovish, I'd say a very dovish policy stance. But the whole idea of the business cycle being dead came from the idea that the Fed really stepped in early on last year, really pumped money into the economy and prevented a very bad situation from becoming even worse. And some people have run with the idea that in the future, the Federal Reserve can do pretty much the same thing. We disagree. We think the business cycle is still very much alive, and we're seeing evidence of it now.
And equity valuations are being called into question with rising interest rates. With rates as historically low as they have been, are equities overacting a bit? Doesn't this mean the economy is doing better?
Well, there's just a lot of uncertainty about just where interest rates will go. Last year, the market was driven principally by this decline in interest rates that accommodated higher valuations in the market. This year, as interest rates move up, those valuations are facing headwinds a bit. We still think, though, to your point, the economy will remain strong enough to produce powerful earnings growth, and that will be enough to produce moderate gains in the stock market in 2021.
How concerned are you about the latest surge in yields?
Well, there's some uncertainty about that. We think that ultimately yields will settle out a bit, but just given the strength in the economy, the reopening, and then the Biden administration and the Congress coming in with a very stimulative fiscal package, the concern is that the economy will come roaring out of the gate. As we think it will, that creates a lot of uncertainty about inflation, and we could see something of an overshoot for a time in interest rates as they follow inflation higher. Ultimately, later in the year, we think inflation will calm down a bit, level out at a higher level than what we've been seeing, and interest rates will stabilize as well. And that will provide an opening, I think, for the market to focus again on earnings and continue to move higher.
And pivoting to oil, it appears that the supply strategy shift has worked well. What are your expectations for demand and the price of oil?
Well, we do think the demand for oil will be going up. The market's anticipating that, I think, in sending oil prices higher. That and surprising discipline by OPEC, I think, has contributed to that price increase. Later in the year, we think supply will be increasing a bit. Demand will, in all likelihood, increase in line with this global economic recovery. But we think that discipline that OPEC has exercised will ease a bit now that oil prices are high enough for them to finance their budget deficits, other spending, and we could even see the fracking industry here ease up on some of the discipline that they've shown and increase supply as well. So we do think that prices will be moving back down toward the $60 per barrel level later in the year.
And finally, let's discuss sources of alternative income. As mentioned earlier, it's still a very low interest rate environment. Where else are you looking for income?
Well, for starters, we're taking a more defensive approach, which means we're not extending maturities the way we did earlier. We're pulling back a bit into, say, intermediate securities. Bonds still have that advantage of providing diversification in a balanced portfolio. But for those investors looking for yield, we think there is still opportunity out there. Preferred securities tend to move with risk assets, even though they're long duration, and we do expect to see those high yields attract some investments. Munis as well, the after-tax yield will become more attractive. It already is, and with tax rates likely to move higher as part of a Biden tax increase, that's another area of opportunity. Finally, outside the bond market, master limited partnerships could offer some attractive returns as well, given the streamlining they've gone through, even as oil prices, we think, move moderately lower. Better business models, streamlining, we think that they offer opportunities as well.
All right, Gary, we appreciate the insight. Thanks for joining us on Trade Talks, and thanks for joining me. I'm Jill Malandrino, global markets reporter at Nasdaq.